So guys, these are the different types of market execution or market orders, right? We have different types of what market orders. We have the market execution, the buy limit, the sell limit, the buy stop, the sell stop, the buy stop limit, and the sell stop limit. Now, in this type of market, we have two types of what orders: the market order and the what the pending order. Now the market order is a type of order that you place and the market gets executed at instant rate. Okay, it is a type of market that gets executed instantly. It means that you are buying at the current what market price. Now this particular price now, for instance, is 1 point what, sorry, 198.68. That is the current price, and this is the current price that you want to buy this market. You don't want the market to get a bit higher or lower before you enter, right? You want to enter this market at this particular price. That is what market order, also known as what instant order, a type of order that you place and it gets executed instantly, right? So you can just say, I want to buy this particular market at the rate of 198.68, and my stop loss or the risk of pip I want to take should be 20, right? That should be 4, sorry, 48, right? 48. That is the pip you are risking on this trade, and your take profit can be above, let's say 1.198, sorry, 0.99, right? That's about 21 pips. That's for what? Market order. A type of order that you place and it gets executed at current market price. Now let's talk about the other type of order, which are the pending orders. The pending orders include the buy limit, sell limit, buy stop, sell stop, buy stop limit, and sell stop limit. So these are the different types of order you place so that it can get executed at a particular market price in the future, right? Now the first one is the what? The buy limit, sorry, the buy limit. Now the buy limit is a kind of market that you enter in the future. You enter the market so that the market can be executed what in the future. It is a future price order. So what do? In a buy limit order, it is a type of order that when the market is, for instance, going or making an uptrend, higher highs, higher lows, higher highs, higher lows. So it is a type of market that you are waiting for a pullback before you enter the market, right? A type of market that you are waiting for a pullback to get to a particular spot. You don't want to buy at current market price, which is 198.68. You want to buy when the market comes down. That's the limit. So you are telling the broker that this is the amount, or this is the price target that I'm expecting to buy this market. So whenever the price drops to this area, I should buy. Let's assume that, for instance, now the you want to buy below the price and you want the market to get come down to, let's say, 198 point, let's say 50, right? That is where you want to buy the market. That is where you want the broker to execute the market, to execute the order, right? So this type of order is used in a pullback in a pullback market, right? In a pullback um market, when the market is making higher highs and higher lows, or maybe in a ranging market, whenever the market comes down to below the current price. So you are telling the broker that I don't want to buy at the current market price. I want to buy below the current market price. And whenever the market comes back or comes down to this particular price, which is 198.50, then place the order for me, right? So you are telling the broker that I don't want to buy at current market price. I want to buy below. So you are using this type of order because maybe you are not around, or you may not have the time to place the trade, or you may miss the market. And because you don't want to miss the market, you don't want to miss the target or your entry, then you place this type of order, or you use this type of what, pending order, which is what, the buy limit. All right, so this will buy limit. Now the sell limit. Now the sell limit is used when the market, for instance, is making a downtrend, a lower high, a lower low, a lower high, or a lower low, right? Or maybe making a range, a consolidation period. Now, it is a type of market that you're telling the broker that you don't want to buy, you don't want to sell this market at the current market price. So, whenever the market comes or rises up, place the trade for me. Now, let's assume that this market is, as we can see here, it is currently at 198 point what? 68. That's the current market price now, right? That's the current market price. But you don't want to sell at this 198.68. You just want the market to what? To go a little bit above. You want the market to, for instance, let's say you want the market to rise to 198.90. That is where you want to sell the market. So you are telling the broker that if the market gets back to this area, which is 198.90, then place the trade for me, place the selling order for me, right? So this is the function of what is sell limit, selling the trade above the current price, not at market price, right? So use this kind of order in a pullback market or in a ranging market that is consolidating, right? So that's for the sell limit. All right, so let's go to the next one. The next one, which is buy stop. The buy stop order or the buy stop market order is another type of what? Pending order that you are asking the broker to buy when the market breaks a particular spot, right? Let's assume that the market is currently at, or first of all, the buy stop is a type of order that you use when the market is gaining momentum, or is it has been able to break a particular structure with a very strong momentum. So whenever the market is reacting, let's say you are going for a buy and the market is reacting in a very strong with a very strong bullish candle, right? And you are saying that if the market can break this level, now the market is currently at 198.68, right? Now you are saying that if the market can get to this level 198.75, then the broker should what? Execute the order. The broker should what? Execute the order. That means you are having this faith and this belief and conviction that the market, having be able to get to 198.75 above the current price, which is 198.68. That means you are having faith that the market is going to what? Continue to rise. It will continue to gain momentum and start trending upward. So it is a type of market that you use when you are having the belief that the market, for instance, if the market breaks above the current price and gets to this particular price that you are targeting, let's say this is your target, right? We are assuming that this is our target, 198 point what? 75. If it gets to this place, the broker should activate the order, right? This is the function of what? A buy limit. I'm sorry, buy stop. All right. Yeah, so let's go to the next one, which is sell stop. Now, sell stop. Sell stop is the opposite of what? The buy stop. Now, note that the stop order is a type of order that you are using in case the market is able to break with a very strong momentum above the current price or breaks down below the current price. When the market is what? Showing strong momentum or reaction, and you are saying you are giving it a target that whenever the market is able to get to a particular threshold, let's say gets to, let's say, 10 pips ahead of the current price, then the order should be activated. That means if it has been able to increase to a particular price, which is from the current price to your target 10 pips above the current price, then the order should be activated, right? That is when you use what? Stop order, which is what? The buy stop and the sell stop, right? So let's talk about the sell stop. Now, the sell stop is used when, for instance, let's assume the market is currently at 198 point what? 68 as usual, and you don't want to sell this market at the particular current price at the moment. You want the market to increase a little bit above the current price. Let's say 198.85. That should be about how many pips away? 70 pips, right? So you are expecting the market to get to or increase by 70 pips so that the broker can activate the order and place the sell order, right? So this is the trigger. You want that whenever the price can trigger this price range, then the order should be activated. The order should be what? Activated. So that's for the what? The sell stop. Now let's talk about the um, buy stop limit order, right? The buy stop limit. Now, the buy stop limit is a type of limit order that is not usually used by traders often, right? It is rarely used. Okay, so the buy stop limit is a type of order that you used or you place so that whenever the market gets to a particular price, then the order should what? Be activated, right? Let's assume that you have missed a trade and you are expecting what? A pullback, right? You are expecting a pullback. Now, what you are expecting is that whenever the market can come down to, let's say, it comes down to 198 and 198.68, right? Or let's say the market is currently at 199.99, and then the market now pulls back and comes back to 198.68, but you are not entering the market at this particular current price. You are entering the market at a set limit order. Now, in this type of order, you want to enter this market, but we are telling the broker that if the market can break this part, if it can hit this particular price range, which is 198.80, if it can hit that target, right? If it can hit that 198.80, this is my trigger. This is my confirmation point that if the market hits this target, then I'm sure that it will continue to rise. But I'm not entering the market at this particular price, right? Now that it has been able to hit 198.80, I'm not going to buy there exactly. I'm going to set a price that if it can drop a little bit above, a little bit below to 198 point, let's say 198.75, right? 75. If the price can drop down a bit so that I can reduce my risk. I'm not entering at this particular price. This is my trigger point, but this is the price at which I want to enter the trade. It has been able to hit 198.80, but I want it to come down to 198.75 and then activate the order. Right now, this is my trigger point. Like I told you, that this is the trigger point. This is my confirmation area, my confirmation price range, that if it hit 198.80, right, then I've already confirmed that this market is going to continue upward. But I'm not going to buy exactly at 198.80. I want you to come down a little bit by 5 pip, right? 5 pips, and you enter at 198.75. So if the market can come down from 198.80 to 198.75, then the broker should what? Activate the order, right? That is the function of a buy stop limit. A buy stop limit, whereby you are using uh the price, the stop area, at which is 198.80, as the trigger point, the confirmation point, right? But this is the price at which you want the market to be executed, right? That is for what? Buy stop limits. Now let's talk about sell stop limit. Now the sell stop limit is the opposite of a buy stop limit. It's also a type of order that you are asking the broker that if the market can rise up a bit to a particular level and then make a sign of reversal and goes down to a particular price and trigger a particular price, then you wait for the market to come down a bit, right? To go up a bit, let's say by 5 or 10 pips, and then activate my order. Now let's go with this example. Let's assume this market is currently at 198.50, right? The current market price, for instance, is 198.50, but you don't want to enter at that particular price range. You want the market to come back to 198.68 or 198.75. 198.75. That is where you want the market to come down to. And if the market happens to come down to that place and then it now reverses and go down a bit to, let's say, 198.65, right? 198.65. Then you are telling the broker that if this market can trigger this point, I know that it has come to this 198.75, but I want it to go down, to reverse and come down to 198.65 as my trigger point, as my confirmation point, right? So you are telling the broker that if the market can come to 198.75 and reverse and then come to 198.65, then this is my trigger point. This is where I'm saying that if the market, that means you are telling the broker that if the market or the price happens to get to this particular range by reversing to this particular range, which is 198.65, then confirm it as my trigger point. Confirm it as what? My trigger point. But I'm not going to enter there. This is my trigger area or my confirmation point, right, that I've set. But I want the price to go a little bit above to, let's say, 198 point what 70. So you are doing this to reduce your risk. You are not entering at this particular price now. You are entering a little bit above the particular price trigger, right? This is your trigger point, but this is the um price you want to enter the market, right? The market has been able to get to 198.75, but if the market can go down a bit to 198.65, then confirm it as my what? My trigger point, and allow the market to come up by 5 pips and then place the order for me. That is what you are asking the broker to do for you, right? So that is the function or the duty of a sell stop limit. So that's for the different types of what? market execution, right?
So, guys, that's the different types of market execution. All right. So, in our next video, we are going to be talking about the market structure, how to analyze the market, the chart. All right. And if you've not subscribed to my YouTube channel, please subscribe so that whenever I drop a video, you'll be able to be notified and watch the video very well and understand how market is analyzed. All right. So see you in my next YouTube video.